Mbss. This is a pretty cheap coal-related company. So sales growth is negative, minus 22% in the first quarter. And you can see both the tug and barge and the floating crane down more than 20%. So the growth has turned pretty negative. But we think this is the pattern. So sales should start to rise again. And we're predicting growth of 5.6% in sales for the next 12 months. So the cash flow has is also down a bit, but it's still quite high and quite positive. There's working capital in there, so we'll take that out. And so it's $8 million of cash flow in the first quarter. So it's dropped quite a bit as the sales are slowed down, but we think it can rise back up to 10.5 over the next 12 months. So you can see the cash flow is pretty good, and the cash flow is doing better because the investment spending has slowed down. And this is pretty exciting. In the balance sheet, this net debt has turned into $5 million of net cash, and we think that's going to, because of the free cash flow we're forecasting, that's going to rise, and we're predicting a 1.8 million dividend. So the net cash is getting pretty strong. In profit, this is the cash cost ratio for the last 12 months. So that's what we're using going forward. And they've been loss making, but we have a forecast of 0 net profit. So this is an example. The depreciation is pretty high. So it's making the profit negative, but the cash flow is positive. So maybe investors are kind of missing this one. So if we look at the valuation, here's the cash flow, 10.5 million, that's our valuation. So this should be worth quite a lot, this company. It's not. These coal stocks seem to be very cheap. So to get it into a sort of more in-line valuation, we're using an 80% discount, which is a target price of just over 1,000. So you can imagine what that would be like if we fully valued the cash flow. So a very cheap stock. The sales not doing so well, but we think they're going to pick up. Cash flow is good, paying dividend and building up some net cash. Very attractive.